Good evening, everybody, and welcome to the 5th episode of Market Replay. Right? If you're tuning in for the first time, just to give you a brief description about this series of videos. So, what happens with these series of videos is that I look at a day's worth of price data, right, in the form of candlesticks for a certain currency pair, and I then drill deep into that set of data, which are your candlesticks, and I highlight the different trading opportunities that were presented to us and how we might have taken those opportunities when it was a live trading situation. Right? So for today's episode, we will be looking at the New Zealand dollar against the United States dollar. Right? Not to waste any more time, let's get into it. Right? Like you already have picked up from previous episodes, the first step is to start by outlining our set of data, right? And this data is for the 15th of July, which was a Wednesday. So we will be looking at the entire Wednesday, all right, using the 15-minute chart because we are day traders, right? And we'll be looking at the different trading opportunities that were presented, okay? Zooming in and starting out with our trend, right? The bulls kicking off our day, right? Continue to push and create higher highs and higher lows. Head our area of consolidation. Okay, these areas will be revisited later and we'll be looking at how we would have dealt with them, right? So our first area of consolidation before the breakout. Okay, price went further, okay, then gave us a breakout with the bull still being in control, right? And after the breakout, we then had another area of consolidation right here. Okay, let's mark it out. Okay, further breakout of price with the formation of a higher high and a higher low over here. Okay, and then the bulls finally lost the battle and the bears kicked in, right? So we then had the development of lower highs and lower lows. Okay, further push to the downside, right? The bears then lost the battle, bulls kicked in. Okay, let's see how long they managed to sustain this trend, right? Continue to push towards the upside. Okay, continued and gave us our higher highs and higher lows. Okay, brief area of consolidation, right? Let's highlight that. Okay, then continued push to the upside, right? Giving us our higher highs and higher lows, higher highs and higher lows, right? The bulls then lost the battle and the bears kicked in, pushing us into the downtrend. Okay, but the downtrend wasn't sustained for too long, right? With the bulls then regaining strength and continuing to push the trend to the upside, right? Minor bit of consolidation here because price was moving quite sideways. No site had a defined win, right? Then the bulls then came in, changed trend to the upside. Okay, continue to push the trend up. Okay, bulls continued, took a bit of a pause, right, and gave us our area of consolidation. Before the breakout to the upside. Okay, gave us our higher low and our higher high, and another area of consolidation where they took a break before the breakout. Okay, then had a breakout to the upside, right? Then the bulls finally lost the battle and the bears kicked in, pushed trend to the downside. Okay, and had a huge area of consolidation here, right, while the bears were gathering enough steam to continue to push the trend to the downside, right? Then had a breakout to the downside with the formation of our lower high and our lower low. Okay, more consolidation over here. Let's mark that out, right, before the breakout to the downside continued, right? Right, price then consolidated, okay, with the bulls then trying to kick into the market, right? And this is how our trading day would have ended for the Wednesday. Okay, let's just save that. Right, now these yellow boxes are all the areas we're going to revisit and try and understand how we would have taken the particular trading opportunities that were presented to us, right, within these spaces of times. And we're going to use a lower time frame for that, right, because we trade using 2 time frames. Okay, the highest time frame gives us our trend bias, and the lowest time frame then gives us opportunities to enter the market, right, where we can then get better risk reward ratios when we enter. Okay, let's start off with our first consolidation region, which is this region over here. Okay, this region. Let's move on down lower. Okay, let's understand this, right? Like I always teach, and I'm sure you guys are now picking up the trend from previous videos, we start on our left hand side. Okay, what do we have a swing high. Okay, what does the swing high tell us? It tells us that we have the formation of a barrier in the form of a support zone over here, right? And that support zone then gives us 2 possible outcomes, right? Number 1, the outcome is that price may hit our area and then push back to the downside, or number 2, the bulls may have enough power and break through our barrier, right? But you should just keep in mind that this support region acts as your barrier, right? Let's pull out our modified Fibonacci tool, focus this entire move. We had pretty good pullbacks, right? Like I always say that we only care about pullbacks that happen from 50% downwards or upwards, depending on which side of the market you are looking at. We had a pretty good pullback, right? Because price then came back and interacted with our support, right? And what did that tell us? Okay, we needed a confirmatory close past that high, all right? And that confirmatory close came in the form of this bullish candle, right? Now we pull out our modified Fibonacci tool, okay, and forecast, right? Okay, now what we can see at this moment in time, right, our risk reward ratio is forecasted way beyond our barrier, and this gives us a bit of a challenge because it then tells us that we stand a chance of not even hitting our minimum risk reward ratio of 1:1, right, which is indicated by this 100% region over here. Okay, so at this point in time we would have not taken this particular trade, right, because our risk reward ratio sits well beyond our barrier, and because we don't know the final outcome of the barrier, we wouldn't have taken this particular trade. Okay, But in future, there are ways in which you can mitigate against this happening, all right? And that's by having a look at the formation of this particular zone over here. Okay, having a look at the formation of this particular zone, we can then see that we had further retracements into our zone, right? This almost resembles a triple bottom because price bounced thrice within the strong support that was created over here on this lower time frame, right? And with an entry at your 50% level, with your stop at 100, you are then looking at a risk reward ratio that's greater than 1:2, right? And that's how you could have taken it in future, right? But then you still had to wait for price to pull back to this particular support region that was created on your lowest time frame. And that's how you would have mitigated against the risks of entering where your minimum risk reward ratio sits well beyond your boundary, which is in the form of this resistance zone that we have. Okay, and that's how we would have then approached this particular consolidation region, right? Let's move on to the next one. This is our next consolidation region. Okay, right, had a beautiful setup over here, right? Step one, start on your left. Okay, what does the left give us? Swing high. What does the swing high give us? Gives us the ability to understand history, right, and forecast it into the future. And we had that through the development of a resistance zone, as you can see over here, right? What this then tells us is that price might hit this barrier and then push back down, or if price is strong enough, it might break through the barrier. So you should be careful when you take this particular trading opportunity, right? Okay, price further pushed back to the downside, and what we have over here is very interesting, right? Because it's only our highest time frame that confirms our trend change, we have the classic example of a fake out pattern that is developed right here. Okay, and let's look at how we would have then taken the particular trade. Okay, right, so we were needing price to close back within our barrier, which it did, and forecasting from this candle, okay, with your stop just a few pips away from the low, we can then see that this particular trade presented us with a risk reward ratio that far exceeds 1:2. All right, so this was a very good trade to take because your expected gains were outnumbering your projected losses by far, right? Because I mean, your minimum is sitting below your barrier, which is 1:1, and 1:2 is still sitting below the barrier. So we're probably looking at 1:5 around this particular trade, 1:5, 1:6 risk reward ratio, and that's stemming from this fake out that we have highlighted over here, right? And this is how we would have approached this particular consolidation region, right, using the Ace Forex Academy specific candlestick momentum pullback trading strategy, right? So this was a pretty good trade, pretty rewarding trade to be part of. Okay, let's look at the next consolidation region, which is the region that sits over here, okay, with the breakout there. Right, let's have a look. Same as always, start on your left before you move right. Okay, this is our left. Okay, what do we have? We have the formation of a resistance zone. Okay, and that automatically tells us in our minds that we have a possible barrier at this level, right? So price then came back to interact with our support level over here, right? And what that told us was that we needed a good confirmatory close past this high. Okay, let's pull out our modified Fibonacci and forecast the move. Right, there we go. So your stop would be sitting below this low over here, a few pips below this low, right? And it's just unfortunate that in this case our minimum risk reward ratio of 1:1, okay, which is represented by our 100% level over here, is far beyond our barrier, right? So this is too risky to trade. Okay, but following the normal price action conventions, we then see the following. Okay, use this color. Number one, price pushed, broke out, okay, hit the top, came back to our resistance zone, and then bounced back to the upside, right? And this is how you would have traded the retest of our zone upon the close of this hammer candlestick that we have over here, right? This hammer pattern. And that's how you could have taken it, because it rejected our zone quite clean, right? And very strongly, because I mean price challenged it once and then it moved to the upside. Okay, this is how you would have approached this particular trading opportunity that was presented to us. Okay, let's have a look at the next one. Right, start on your left. What do you have on your left? Your swing high. Okay, and this swing high then allows you to forecast your history into the future, right? Okay, let's forecast that. Okay, so we already have our barrier set up in this region, right? And what's nice about this setup is that we had quite a deep pullback, because price pulled back to our support level, right? And in doing so, what did this then notify us of? We needed a close past this high, confirmation close past that high, and would have entered a buy position, right? And the confirmation close came about on the close of this bullish candle. Okay, let's forecast using our modified Fibonacci. Okay, there we go. So what we can then see in this particular case is that our minimum risk reward ratio, right, which is 1:1, sits on our boundary. Okay, and this then allows you to take this particular trade, right, because you are guaranteed that price will come to this boundary and retest the boundary. However, what you don't know is how price will react to the boundary. But for there to be a reaction, you need interaction, right? So this is what we had in this case, right? We were assured that there will be an interaction, but we were not assured of the type of reaction. Okay, so we would have entered this trade and we would have taken our profit at 1:1, because our take profit level would be sitting in our resistance zone. Okay, and as we can see, the resistance zone happened, price interacted, bit of a fake out and a push back to the downside, right, wiping out any positive stops that might have been placed. But we were safe on this trade because we would have exited, right, at our 1:1 risk reward ratio, which is our minimum risk reward ratio that qualifies as entry into a trade, right? That's how we would have taken this particular one. Let's move on to the next one. Okay, let's have a look. Right, let me just remove that zone there. Story never changes. Start on your left, understand your history. Okay, and after understanding your history, forecast your history into the future so that you don't repeat any mistakes, right? I mean, that's a general life lesson. That's why we are then taught history at school. It's to learn from our mistakes, or to learn from certain behaviors, right, so that we can pick them up in the future and present any negative or prevent any negative outcome from having a repeat of those behaviors. The same thing applies to price. That's why you need to understand your history. Okay, your history tells you what might happen in the future and what to look out for when you see a set number of characteristics, right? And that's what we have over here. Okay, we have the formation of a resistance zone, right? And what does the resistance zone tell us? Barrier. That's number one. That's supposed to come to it. It's telling you a barrier, right? And while we're having a look at this barrier, we had a deep pullback to our support level. What this then indicated to us was that we needed a good confirmatory close past that high, which was very minimal there. We need a confirmatory close past that high, and it came in the form of this bullish candlestick. Okay, using our modified Fibonacci tool, all right, using our modified Fibonacci tool, we can see the same aspects that we had from the previous trade, right? With our minimum risk reward ratio setting in at our resistance level, right? And like I said, because we have a resistance level over here, we are assured of a interaction, but we are not sure of the reaction, right? So we needed to wait out and see what the reaction would be, right? But to not miss the move, we would have entered a buy upon the close of this bullish candlestick, taking profit at our minimum of 1:1, right? You would have still been safe if you had a positive stop after price hit your 1:1, and that would have given you a good 1:2 risk reward ratio from this particular trade, right? And simply that's how we would have taken this particular opportunity. Very simple, right? These deep pullbacks are amazing. This is what we always strive for, these deep pullbacks, right? We don't like shallow pullbacks. You need the deep pullbacks all the time. Okay, let's have a look at the next one. Just this one over here, right? Let's have a look. Okay, same as always, guys. The story never changes, right? Look left before looking right. Okay, what do we have? Swing low. What does a swing low give you? Support region, right? Area of support. Okay, and what does your area of support tell you? Apart from telling you that there is a barrier there, it's also telling you that there might be buyers parked there, right? There might be a lot of buyers parked here. All right, so your demand is very high in this region, and that's why price turns around. Okay, you need to understand the basics of supply and demand. All right, it works in every business. Okay, same thing, same story, same principles applied to trading as well, right? Because we know that this is our area of demand, we know that there are a lot of buy orders that are waiting in this region, and if those buy orders far exceed the selling orders, right, or when the sellers start exiting in this region, okay, by taking profit, the buyers can then overcome the market and push prices up. All right, so then let's have a look. We had this formation of the support zone, all right, and then price pulled back far enough to interact with our resistance level that comes from our highest time frame. All right, and in this particular trade, what this then told us is that we needed a confirmatory close past that low over there, right? And that came upon the close of this bearish candlestick, right? Let's pull out our Fibonacci. Okay, let's forecast the move, right? Now, using a very conservative stop loss, what we can then see is that number one, our minimum, okay, our minimum risk reward ratio sits far beyond our boundary. Okay, so that already excludes you from taking this trade if you're going to use a very conservative stop loss. But using a more aggressive stop loss, what we can see is that our minimum risk reward ratio, okay, which is 1:1, sits well above our support zone over here, right? And this would have given you the go ahead to enter this particular trade, right? And if you took this trade upon the close of this bearish candle, you would have then had a good 1:1 risk reward ratio, right? If you had placed a positive stop, you're going to be stopped out and you would have broken even, right? That's why it's always recommendable to take some profit, right, and not put your entire trade on break even. Okay, and that's how we would have approached this particular trading opportunity, right? Let's have a look at the next one, which is our last one, and it's this one over here, right? Let's have a look at how we would have approached it. Clean up the chart a bit so you can see, right? Right, guys, the story is still the same. Look left, support zone. What does support zone tell you? Barrier. Why is it a barrier? Because buyers are parked here. Okay, buyers are waiting to enter the market. Remember, you buy the CFD when it's cheap, right? You don't buy at the peak, buy at its cheapest. So this at this present moment was its cheapest, right? And this is where the buyers were then parked, right? What we then head over here, pull out our modified Fibonacci tool, and let's understand the pullbacks that stem from this move to the downside, right? We had our first pullback in this region, right? And what this then told us is that we need a confirmatory close past this low, right? But later on, price then came back to interact with our resistance drawn in on the highest time frame, right? And this then told us that we needed a confirmatory close past that low, right? Let's have a look at both of them. This first trading opportunity taking a sell upon that close, what we can then see is that our 100%, right, if you can see it, our 100% level, which is our minimum 1:1 risk reward level, sits well above our support zone, right? So upon taking this trade, you would have then had a good 1:1 risk reward ratio profit from this particular position, right, with a suitable pullback that was far beyond 50%. Okay, and like I said, let's look at what happened, right? What we know about this region is that we are assured what an interaction, right, but we are not assured of the reaction. Okay, and understanding this region here, like I said, buyers are parked here. This is your area of demand because price is cheap. Okay, some sellers were taking profit and we were part of them here, so we weakened the force behind the sellers, right? And the buyers then managed to push price to the upside, right? But what does this resistance level drawn in on our highest time frame tell us? Tells us then that this is our area of what? Supply, our maximum area of supply, right? You then what do you do? You as a supplier, when you think of it in business terms, as a supplier, what do? You supply your most when price is the highest. Okay, and that's where they then sell their CFDs, right? And this is what happened over here. So the sellers then flooded the market and caused price to come back down, right? Buyers that entered here then had some sort of indication, okay, that they should start taking profits over there, and that weakened their side and they stopped pushing prices higher and took a pause and price came back down, right? Hope you guys can understand that story. That's what's supposed to be running through your mind every time you're trading. You're supposed to be understanding this war between the buyers and the sellers, right? Works as a business. This will help you then take logical trades, right? And that's why we wait for retracements. That's why we don't sell on the troughs, and that's why we don't buy on the peaks, right? Let's have a forecast of this region. Okay, so same story goes here, right? Our minimum risk reward level sits well above our barrier, right? So we would have taken this opportunity, and as you can see, our 200 was sitting in our barrier as well, and this would have given you a good 1:2 risk reward return from taking this particular trade. And yeah, let's have a general look. That was how your markets performed on Wednesday, the 15th of July, for the New Zealand dollar against the United States dollar. And this performance was much better than what we had yesterday, or when we were looking at the United States dollar against the Japanese yen. The New Zealand dollar was very rewarding in this aspect, right? Everybody, I trust that you enjoyed the video. I trust that you understood everything that I was trying to relay to you guys over here. Please do like the video, and in the comment section, please do give me suggestions of any other currency pairs that you would like me to review, and I will make sure to include those in the next episode, right? On another note, please do hit the bell notification icon so that you are alerted every time I post another video. Thanks for watching the video, guys. Cheers.